Good afternoon, investors. Welcome to the September 17th, 2024 edition of Bull Sessions. My name is Mark Robertson, and I am joined here by some wonderful investors and friends. First of all, that magical mathematician from mid-Michigan, Ken Kavula. Good afternoon, sir.
Good afternoon, Mark. We're back to all the M's again, aren't we?
I only did one. That's just to keep Kevin
All
at
right.
bay. Got to keep him at bay. And we're also joined here this afternoon by Kim Butcher, I think of Indiana these days. Is that still correct, Kim?
I'm in Florida now.
Oh, okay. We can't pin you down.
No, next month it'll be somewhere else.
There you go. Depends on where the band is. Go where the band is.
No. Well, next month I've been invited to stay with friends, so I'm gonna fly to Hawaii.
Oh, that's a tough job. Somebody's got to do it.
Darn the bad luck.
Yeah, somebody has to keep those airplanes flying, Mark, so it might as well be Kim, okay?
All right, and we're also joined by Houston's Matt Spielman. Good afternoon, Matt.
Good afternoon. Yeah, I drove for a long way and I'm still in Texas.
There you go. Yeah, that is possible. All right. That is not a picture of my wife's work area, but it could be. She's got all kinds of stuff like that, a whiteboard, 2 screens, and she was joking about that could be her place, including the plant, which is nearly killed down at the bottom of the picture. These things happen. But we are going to talk about business models, fancy word for just understanding the company that you own, at least to a level of depth that can, basically keep you in the ballpark for understanding and comprehending what they're trying to do as they seek to be a continuously operating company in the future. And we will spend a few moments with Prove again, just kind of reinforcing some of the concepts. Ken and I have talked about having another session where we try to come at it perhaps from a little different angle, but certainly work through the calculations and continue to demonstrate why it is, we think it's a formidable resource in what we do. So anything you'd like to add to that, Ken?
No, I really like Prove, and maybe we can convince people that Prove is very useful in proving a lot of things, and we'll point to what it might help you validate and verify. So that's a good thing.
I would also note that all the animals on the chart have marked themselves safe in Springfield, Ohio.
Don't even move it, okay?
Well, you can't completely avoid the subject. Here is our weekly reminder.
My goodness, I missed the sign picture here, Mark. Okay.
I mean, this is our weekly reminder that Portillo's is not a sponsor of the session, but they should be. Kim sent me the one with the cheeseburger, I think. But I
think so.
From not 1, 2, or 3, I actually received that other sign from at least 4 of you. And I don't know what that says about me.
Now, this is not, just to be clear, this is not a Portillo sign, right? This is a Wiener Circle.
It's a competitor even.
A competitor of Portillo's. Okay, all right.
But we will point out that the stock price actually reached 13.5 this afternoon, so it's headed in the right direction, as is Five Below.
The last time I looked, the Russell 2000 was having quite a day. It was up about 1.5%. I don't know if the market's turned around or anything, but it was really moving in the right direction for a change. That's a good thing.
But the bottom line here is none of the pictures on the left are my fault. They were just injected in here by you ruffians out there in the audience. All right.
You sound like somebody that was sent to my office all the time, Mark. Okay.
I've been in that chair, Ken. I've been in that chair. All right. And for those of you out there that want to avoid the principal's chair, or at least the chair in front of the desk of the principal, please keep these things in mind. No investment recommendation is intended. Everything we do here is about education and more specifically demonstration of some methodologies and techniques that have worked very well for many of us for a number of decades. We basically think that the last 8 decades of lessons learned by the modern investment club movement are rich in opportunity and basically stacking the odds as well as you can in your own favor. There are no guarantees in the realm of investing, but stacking the odds in your favor is something that you can endeavor to do that can be a very rewarding enterprise. So we'll be expressing opinions. Please make your own decisions about anything related to companies or investing resources. And our 2 email addresses are down there at the bottom of the page in case you have follow-up topics or suggestions or questions. And if you'd like a copy of the slides, you can also send me a note, markr@manifestinvesting.com. Anything else, Ken?
No, I'm ready to get started. I like some of these slides today, Mark. So
All right.
this is a good one to start with. I love the note you've put on this one this time, Mark.
Yeah, it just is a pretty good reminder the stock prices fluctuate, right? And our community knows better than to be too disturbed by any type of short-term or even intermediate-term activity. Because I think it was just a week ago, Ken, we were belly aching about the amount of space between the blue line and the green bar.
The light green bar, right? And we're now up to that line of reasonable expectations again. That's been the line that sort of measures the growth of the stock market for long term, and it's showing somewhere between 9.5, 10.5% growth. That curved line is showing there. It's curved because we're graphing it just on regular plain old graph paper, not any kind of fancy stuff. If we were graphing on fancy paper like we do SSGs, the blue line would be straight. It would be up and straight. Wouldn't be parallel to anything, but it would be up and straight. I'm babbling now. Keep going, Mark.
I do think Value Line got caught doing their calculation before Friday, and that I would predict that 45 will become 40, maybe even 35 if the strength in the market keeps up. I happen to believe that whatever they decide to do tomorrow afternoon, we could be in for a little bit of a price swoon just because we've been building up to this first rate cut for a long time now. And I'm not sure they're going to make anybody happy with what they do, 25, 50, or 75.
Well, I'll tell you, Mark, I'm watching them construct a new deck up behind my house. So I'm sitting in the family room this morning at 10:30, and I turned on CNBC expecting to hear something, relatively happy about the fact that the market's had a pretty good week. In fact, it's had an excellent week. We had a day last week that was the best day in over a year, or almost a year. And instead, I listened to a panel tell me that because we've had 6 good days in a row, doomsday is on its way, and we're going to, September is the most terrible week in history, and this is the start of the September swoon, and blah 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 blah. And the talking heads just got me very depressed. So I turned TV off and went back to watching them dig post holes. Okay?
And watching the turkeys run around in your backyard. I'm referring to.
Yeah.
All right. Here's a look at our performance perspectives just to keep things in perspective. And Ken asked me to change all the dates to a 10-year trailing situation, and I think it illustrates kind of what you had in mind, Ken. Couple of the companies.
I had gotten a lot of comments, Mark, about Cognizant, and I think we just wanted to demonstrate that we knew that in the last 10 years, Cognizant has not been performing the way that we would have expected one of the top companies in the Manifest 100 to perform, and this just bears it out. It's been losing to the market. It still has a positive return. It's still a 7.7% positive return, but it is losing to the market, which is pretty healthy right now, giving us a benchmark over those 10 years of 12.4%. So,
yeah, it's hanging in there. And in the interest of full disclosure, I am a shareholder in CVS Health. And I will be sure to let everybody out there know the day that I sell it, because that is the time to pile in, buy my shares, double down on them, because it will take off and go up. But man, this has been a frustrating run for many of us.
Yeah.
And, it's just a
there's
reality.
No doubt. I agree 100%. Well, I can remember times at convention, Mark, where we were debating which is the better stock, CVS or Walgreens.
Yeah.
So that's how I began my convention career with running a panel session with two other folks about which is the better company, and those days are long gone between those two companies. Yeah.
All right, we just actually committed for all of you in the audience the report card sin of focusing on the weakest grades on the report card. It's important to keep the ones up here, those top 7 companies. Those represent 7 of the top 10 most widely followed companies by our subscribers. I own 5 of those 7 personally, and I know that many of you do too. And when you get to do this over a 10-year period, it just put it this way, it leads to situations where you can comfortably turn off CNBC and sit and watch them work on a new deck on the back of your house comfortably. So
we need a new acronym, Mark. We could scooch that bracket down to include Fastenal and call it the Elegant 8. Okay.
Our new Elegant 8. And then, of course, embedded within that Elegant 8, we think it's an extremely important and powerful demonstration of a community of investors coming together and doing this. That being the roundtable that we do the webcast once a month. Been doing it since 2010, as you can see right here. And it's been working out pretty well for us. So good, clean fun. Everybody on the call here right now has served as either a knight or a damsel in that effort, and we appreciate all of that kind of stuff. So we'll just press on. Here's our groundhogs. This looks a little bit clumped together because I went down and grabbed the top 50. I was trying really hard to get to my name and didn't make it. But I told Ken earlier, I keep talking about the number of clubs that are in bold that are just barely below 40, so I thought I would prove it. There they are. And you'll notice that many of those are closely affiliated with Mr. Kavula.
I'm looking to see if Mary Reynolds is on the call today. She's not. Mary is here normally, and Mary's the president of the Antique Warehouse, so she will be very happy to see herself in the top 50 right there. We have a lot of mid-Michigan clubs on this list of top 50, and a lot of clubs from all over. There's 15 of them on the list in the top 50. It's not a new record. We had 14 in the top 40 at one point, but I'm keeping those files going until we end this contest to see how well the clubs actually do in what we're happening. We'd love to hear from somebody that's in the Investment Club of America. Mark and Kim and I and Matt could not come up with the name of anybody that we knew that might be in that particular investment club. So if you're in the audience today from the Investment Club of America, or if you know somebody that's in that club, could you put that in the response in the question box? And we'd like to know that and maybe give them a talk a little bit. They're leading the clubs right now in the race to be the best club.
I know that one of their partners or principals attends the Wednesday morning club every once in a while, so I'll do some digging. I can track them down, Ken.
Okay, great.
Good stuff. So I put the chart in here just to prove a point. Stock prices do fluctuate. We know that. In the Value Line Arithmetic Index, that chart from the previous page proves that also. And this is for the duration of this groundhog challenge. We went from 0% up to 9% really fast, back to pretty close to zero gain, and then back to 9%, and then pretty back close to very small single-digit gains, then back up here again, and we have cycled back and forth now for the last couple of months. So if you're a little bit dizzy or need an oxygen mask, make sure that you take care of those around you first, or take care of yourself first so you can take care of the ones around you. But yeah, there's some turbulence there. I mean, these numbers have been whipping around.
Well, and our friend Jim is certainly giving us a nice foundation to keep those above zero. So
keeping those two numbers above zero, thanks to him. All right, let's keep pressing on. Here's a chart shared by Matt. Matt, I thought this was fascinating. It appears we are not exactly alone in how we view buy, sells, and holds.
Yeah, and even though we were kind of dishing on Morningstar data beforehand, we remember that they think in a time frame similar to ours. So you've shown the graphs of manifest ratings versus the rhinos the last few weeks, and inspired me to do digging. And believe it or not, this isn't published anywhere. So I actually appropriated their filter just to group the star rating, right? So 1 star is a strong sell for them, a 2 star is just a sell, the 3 is a hold, 4 is a buy, and 5 is a strong buy. So I've color coded those appropriately, and seeing that they sort of, although they're still maybe a little bit more buy than sell, and this is from last week. We shouldn't care in time frames that short, but still by and large hold for a very, very large universe of covered stocks.
I'd be interested. Do you have the capability of filtering that down to the value line 1700 or the S&P 1500 or anything like that?
I'm sure I could do the S&P. I never tried, but I can look into it.
I was just thinking, because I don't know if that's is skewed at all by the number of ADRs, and there may be some fairly creative listings out here in this yellow
I'm
bar.
sure.
I don't know. And if they default to 3 stars, and anyhow, I think it'd be interesting because I know they would have pretty concrete ratings on the 1500.
Yeah, and a lot of these are automated. This is not Morningstar's analyst coverage.
Mhm.
That's a much smaller universe. This is all algorithmically or calculated on there. So things like that can happen.
But it is an exception to how we see the Wall Street rhinos behave in general. So it's a very valid point. All right, so I thought we'd tackle a couple of questions that came in from the audience and people that read our bull sessions or watch them afterwards. So this was actually an email I received, which basically said, what happens or what should I be thinking anytime I see a projected annual return, the return forecast is actually color-coded in yellow? And our answer is the same as it has been for the better part of 20 years. It's just simply an indication that to be careful. That could be a too good to be true situation. Anytime a forecast gets that high, success is rare and failure can be quite bad. I'm looking for a tougher word than that, but disappointment can be quite extreme. And we think that that's pretty good advice. So when you see yellow, same thing. The yellow always mean caution, urging caution. Be warned. Be very careful. Danger, Will Robinson. And then if you want a little bit more mathematical answer, that is not a current distribution, but it's not that dated. That's taking all the companies in the value line 1700 and just laying them out by number of companies, so that when you're out here looking at these elevated numbers on the right, you want to be careful anytime you're that far out there. Most of us spend our time shopping for great companies in this zone, and we're willing to tiptoe a little bit to the right, but not too far. So I'll just give you a little way of thinking about that sort of thing. Ken, am I okay mathematically here?
Yeah, I think you're fine mathematically, and I think we should emphasize that end of the sentence under the short answer there, that a higher quality mitigates your risk, so that a par of 25%, 24.2% with a quality of 48 is quite risky, but a par of 24.2% with a quality of 95 would not be nearly as risky. It still carries risk to meet that particular high par value, but not nearly as much risk as a lower quality company might provide.
Okay, so I think that covers that. That's something we've been looking at for a number of years. And here is basically somebody saying that they're still a little bit confused and they need more practice with the projected return on value. And basically our findings, so they're just asking us to go back and treat the subject a little bit. So I just thought I would go, even though this is basically reusing information that's out there, it's a pretty good summary. Again, it's our research basically landed us in the lap of Joel Greenblatt, and he's got a tremendous track record in investing. He is a professor. I think he's at Columbia one of the schools in the Northeast anyhow. And just a heck of a track record. And he has this thing called the Magic Formula. There's a number of books out there. Kim has mentioned them a few times. It's on our recommended reading list. And we look at his Magic Formula, and we just modified it a little bit. And one of the reasons we modified it was he doesn't spend a lot of time digging into smaller companies, and he avoids many of the financials. And neither of those two classifications were going to ever make Ken Kavula happy. So we had to come up with a way to deal with it. And one of the ways we dealt with it, here is the formula. This is the formula for the projected return on value. And it literally is trying to look out, think of it very much like pre-tax income on a stock selection guide, if you speak that language, but we're basically thinking about the operating income, in other words, pretty close to the cash flow from any enterprise over the next 5 to 10 years, and comparing that to the enterprise value, which is on the bottom here, the denominator, which happens to be the stock price plus the total liabilities. And that's a subtle change that we made. Greenblatt basically looked at the long-term debt, but if you look at the total liabilities, you're incorporating all of the current liabilities and all that lease stuff and all that other noise. They're all liabilities. You put those in here and you start watching some magic happen. And then we also account for the cash that's in the company's wallet or checkbook. And the bullet points on the right have not changed. We think that as you go through this and as you play with a few of these, you are being faithful to the stock selection guide from the 1950s, which basically drew our entire attention to the business model, the top line sales, and the first level of profitability. And so again, it's a business model centered analysis, very much centered on the preferred procedure. And we just think that this is all still valid. I think this is probably a better way to think of how important we think this is, or how useful we tend to think this can be. I think the statement up at the top is true. Any dissension or clarification, Ken?
Not at all. In fact, that's its major use, as far as I'm concerned, is the truth of this statement. The fact that your traditional PAR calculation, the potential average return calculation, which you do on almost every single stock selection guide, and you understand that process, that calculation is approximated through the prove calculation, and Mark's giving you the formula, but more importantly, he's said to you, you don't even have to figure it out. I'm going to provide that number, that prove number, for you in the manifest display. So all you have to do is compare the two values, and when they're roughly the same, when they're approximately equal to each other, a mathematical symbol for approximately equal is an equal sign that has got a little bit of steroid attached to it, so it's become wiggly, squiggly. Okay. And when they are approximately equal, then you can have a lot of faith in your analysis. And when they differ by a wide amount, depending on which one is smaller, will kind of indicate to you which one of your judgments is probably a little bit off. If the PAR is significantly less than the prove, are you thinking about that, everybody? If the PAR is significantly less than the prove, then what you want to do is maybe be a little bit more aggressive in your PE judgments when you do your SSG. If the PAR significantly exceeds the prove, if it's bigger than the prove by a large amount, then you probably want to be more conservative in your PE judgments on your SSG. You want to rein them back a little bit. And when that happens, it gives you SSGs that are much more accurate, and it gives you a little bit of guidance for PEs. And let's face it, when we're doing an SSG, we get very little guidance on where to go with PEs, especially with companies that are really growing quickly. So put that all together and see how you think about it.
And again, just a quick reminder that, as you're forming this understanding of the business model, the vision, as you imagine that business going forward into the future, just like Buffett says, imagine if the stock market were closed for the next 5 or 10 years, would you be interested in the company? He's basically encouraging you to close your eyes and envision that company in the future. We recognize that as understanding that top line. What do the sales or revenues look like going forward? What are the factors that influence that or could be a threat to that? And literally think about that. And then on the right-hand side, you basically have a graphic which shows you the operating margin, which is pretty close to a cash flow margin, but the operating margin for a company, kind of a middle of the road statistic versus the net margin, which is the earnings per share profitability, the bottom line for the company. So again, companies they're going to vary. The relationship between those two lines are going to vary by industry, but what you see here for whatever company this is a relatively stable operating margin that apparently was impacted by COVID a little bit. You see that here, but you can make a pretty strong case for a number in that 16 to 18 range for this particular company. And the bottom line net margin somewhere in that 9 or 10% range would make a lot of sense, unless you had other information or other reasons to influence that up or down.
Mark Dennis has asked a question. He said that in the past we've talked about a difference of 5 points differing between the two as being enough to question whether or not we have to adjust forecasts. And I would modify that standard rule, which we would give for a company that trades at single digits or teens or even low 20s. I would modify that rule for higher PEs. I wouldn't be upset at a par number of 25 and approved number of 31. I think they're still pretty close together at that level. I would be upset at a par number of 9 and approved number maybe of only 14. That's 5 points above it. Those are pretty widely spaced when you get down into par improved numbers that are on the low end of the scale. So use your judgment, and I don't think there's a one size fits all number that is going to trigger some thought. Just ask yourself, are these close enough? I'm looking at 6.7 and 8.4, and I'm saying, yeah, those are close enough for me to have some faith in my analysis that was based on the traditional SSG. That's the analysis on the left. The 6.7 is a traditional business model for a company, and it gives you a 6.7% projected return. The prove is a single calculation, and it's giving us 8.4. And again, you don't have to calculate it. It's now part of the manifest database. So it's a number that's there. Use it. That's all you have to do is use it.
Yeah, and so again, we're just making the point that we start in the same place. We want to understand above this line in the side-by-side comparison, we're calculating the sales growth forecast and the ultimate 5-year sales forecast in the same way, and then we're simply going 2 different paths to get to the same endpoint, or maybe I should say similar or approximately equal endpoint. But in the one on the right, you're basically making sure to keep track of the total capital structure of the company, from the equity to the debt to the cash in the wallet, to form that enterprise value. And then I think we'll be doing some interesting demonstrations of, how does that look during a buyback and a few other things here fairly soon. But again, it's this notion of understanding the sales trajectory and then bringing these 2 different profitability paths, if you want to call them that, to it. So we'll put together some other educational sessions on this, but yeah, I agree completely with Ken with putting these 2 side by side. This is one of the toughest numbers in any stock study to come up with. And in some cases, the historical PEs will take you down a path where you might not necessarily want to go. And it's always good to have another opinion to help steer that boat home and produce this number here. All right, I think that kind of beats that one up for now. We'll come back to it. I understand that it's a little tough to get your arms around, but the rather dramatic simplicity that's at your fingertips, again, you go and retrieve these numbers and just crank through them a few times for a few companies. And I would encourage you to do that. We'll do it with you a little bit, but on your own, and just be kind of amazed at another valuable input that can help you with the decisions that you make up here for point number 3. All right, so with that, let's go ahead and switch gears to a quick discussion. I don't want to spend too much time here other than just acknowledge the issue. And this is another question, rather detailed question from somebody in the audience that is pointing out that there's a fairly big difference between the GAAP and non-GAAP numbers for 2 of our community favorites. One is NICE and one is, Ken, one of your favorites, XLS Services. And
Do like that company. Yep.
yeah, these are both companies that have gained some favor, and what this person is basically saying is we're kind of getting tossed around a bit here. We want to understand what we're looking at. How should we think about this? For those of you that are not familiar with the term GAAP, this is your definition according to Investopedia, and it's just a group of standard practices and procedures that for looking at the financials of a company to try to keep some uniformity going forward. So the question basically revolves around this. This could be potentially confusing. How do we think about this? So let me take kind of a step back here again to some of the reinforcement of what GAAP is. It's an attempt to be somewhat compliant with the standard, but I tend to think of it as, and again, I'm not an accountant, but the numbers can get kind of heavy. But I believe this statement to be at least conceptually true, and it's kind of the thing that guides me. I think that you have to be careful with some of the modifications to data or interpretations of financial data. Again, and what we're trying to do, and we're going to go to that here in a second, we're trying to envision this company going forward. Again, some of that business model stuff that we were just talking about, sometimes that the GAAP numbers can actually divert you from really looking at the operating business. And there are some nuances involved here. Here's what we mean by that. This is actually from that article where the photographer from the St. Louis Post-Dispatch took the picture of Ken and then said, "Mark not pictured." I did not put that picture in there this time. But this article, I think it covers the essence of what we do pretty well. The link is down here if you want to go back and visit it. But we're always trying to figure this comprehension of what the business looks like going forward. In this case, Apple, graphing the sales and graphing the earnings over time and just trying to understand the trends. So this is what we're trying to do. And that's a little bit of a shot at those who get in a little bit too deep with the numbers. We're not bank officers qualifying these companies for loans either. So that's where I get a headache every time somebody talks about interest coverage and that kind of stuff. I don't need to know those numbers. Subject for another day. But again, I want to go at least one level, if not 10 levels up from that, and just look at the company from 35,000 feet. And that second statement for me is really pretty powerful. We're building a forecast. Call it an understanding of the company in the future, not filing a corporate tax return. Go ahead.
And I think most of our audience, Mark, is bright enough to understand from 35,000 feet when a GAAP number is making sense and when it's not making sense. And in my estimation, when the company is adjusting a number and giving you non-GAAP data at a certain place, it should be for something that's relatively extraordinary. I think back to when we had the change in tax laws, and suddenly companies had to bring back money that had been, the fancy word was domiciled offshore. Essentially, they were keeping profits offshore. They had to bring that money back in one fell swoop, and then they had to pay taxes on it. Well, that was an extraordinary event that impacted their earnings per share. And I would have expected the company not only to present GAAP numbers, which told what the expenses actually were, but to present non-GAAP numbers, which showed me what would have been happening if that particular one-time event had not happened. In the example we're using for Excel services, and for many, many companies in my experience, they're adjusting data every quarter for stock compensation. And in my mind, that becomes a little bit tedious. And not only does it become a little tedious, I'm wondering if that is truly an ongoing business expense, why don't I just use the GAAP numbers? So there are times when GAAP, I'm perfectly satisfied with GAAP numbers, and there are times when I would much rather look at value line, which tries to make a reasonable judgment on whether to exclude a GAAP number or not. I would much rather look at those normalized numbers. That's the word that they use when they adjust the data sometimes. We know that sales hardly ever gets adjusted. Sales are sales. You can't fool around with them very much, but you can fool around with earnings in quite a few different ways. If it's an extraordinary event, let's kind of ignore that and figure out what it would have been without that extraordinary event. If it's ongoing, then I have a whole different argument for you, and I'm wondering what the company is trying to prove by telling me it's going to adjust every quarter for the same darn thing.
Yeah, and keep in mind that some of those adjustments are federally mandated. Compliance with tax law and that sort of thing. And Buffett has been extremely critical. Munger used a language that I won't use here about some of the stuff, but again, keep in mind that we are talking about, again, maybe it's flippant to think of it as 35,000 feet, but I really want to try to have some understanding and vision for the continuing operations of the company going forward. And that's why we lean, as Ken has already suggested, so heavily on value line and continuing operations data from the provider Y charts. So again, focus on the top line. Go ahead, Matt.
Just kind of to build on Ken's example from the 2018 tax changes, there's nothing that says, there's no law that says that GAAP numbers have to be higher or better than, non-GAAP numbers have to be higher or better than GAAP numbers.
Right.
In the rare case where you find a company actually posts a non-GAAP number that's lower than that, that's a point to pay attention. That's an honest dealer in a lot of cases that may warrant some attention or get some brownie points as management who's in charge of your resources, as the steward of your resources.
Matt, why don't you give a couple of examples about why they might post a GAAP number, a non-GAAP number lower than the GAAP number?
Sure. Well, maybe not examples, but reasons, right? So
reasons. That's a good example. That's what I meant. Reasons. Yeah.
Yeah. Oftentimes, I mean, as you said, so extraordinary items happen, and they're out of the management's control. Is why they want to sort of put them aside. But companies often give guidance under certain rules that might be non-GAAP as well. And if they have, for example, an acquisition or a divestiture that makes a big adjustment or a big change to the business. Now, of course, they'll also do pro forma, which is actually changing finalized reported numbers in the past to also help you figure out the company's trajectory. But in the quarter that a transaction happens, they may have to do some amortization or some other things that make big changes either way. But yeah, let's say I've never seen a company regularly post lower non-GAAP numbers, but they're usually trying to stay a consistent course with how they've guided their analysts or the public in prior statements.
Yeah, let me give you two reasons that I've discovered in my experience. One of them happened again during that big tax change that we had, that most companies took a ding. They had to pay extra taxes, and that came right out of earnings per share. But there was a subset of companies that actually got a tax advantage from that law being passed in that 1 year, and they made more money than they expected. They really didn't make more money, but they got a clawback of taxes that they had already paid, so it fell to the bottom line, and they didn't feel that was going to happen regularly, so they adjusted their non-GAAP number down. Another great reason is sometimes a company loses a lawsuit and that gives them a ding on their EPS, but there are occasions when a company wins a big lawsuit. In either direction, that's a one-time event, and routinely, for big legal settlements, companies will adjust their numbers up or down to reflect the fact that they don't expect that kind of revenue to be lost or to be gained on a regular basis.
Yeah, and we could probably list off a whole bunch of stuff. The one that drives me a little bit crazy is goodwill write-downs. You know, because I basically pushed back on the notion of goodwill in the first place, but yeah, there's just a bunch
If
of
you
other
ever,
stuff.
Mark, if you ever have a stock that's got goodwill of over 30%, they probably bought something and they paid too much for it, and so the goodwill gets written down. So that's always something to keep an eye on.
Yeah, and see, it just bothers me that I'd rather think about that differential without getting too deep into the accounting. If they paid too much for something, they made a bad decision. So, all right, we'll go ahead and keep pressing on. Here is your reminder that we are now 6 weeks out from Halloween, and we begin our quest in earnest. We'll begin whittling down a list here over the next couple of weeks. I picked up another graphic for us there, Ken. The hourglass is winding down very much like the Flying Monkeys and the Wicked Witch and Dorothy.
All right.
But we picked up a quote from Laird Beeger, I think is how you pronounce his name, the Barron Discovery Fund, and that this can be very true. I mean, the last couple of years especially have been pretty tough for small cap portfolio managers. He runs the Barron Discovery Fund, so we thought we'd take a quick look at them, much in our tradition of taking a look at what are the characteristics of the fund. We notice out here that he has managed to achieve an 11.4% return while the market's gone up 12.6. This negative 1.2 for a small company fund is not bad. The average small company fund has actually lagged over that 10-year period closer to minus 5%. So less bad, I guess. But we can see he is actually delving into higher growth rate companies, so that rhymes with what we're looking for. So this is just our process of going in, seeing what we don't cover, what might we discover. Ken, you said you'd actually been through some of these already. Any of these?
I've started to go through them. I haven't found anything so far that I would be really excited about, but I always kind of just gaze on the list before I begin working on a list, and I was happy to see a couple of companies that I was familiar with, so at least I know he's walking in the same park that I'm walking in, at least, maybe not down the same path, but in the same park. I don't know if I would classify Texas Roadhouse, for example, as a small company. I think it's comfortably situated in the medium-sized company category. But Kinsale down there, about 2/3 of the way down the list, is definitely a smaller company, and I think there's many of us in the community that are familiar with that particular ticker, KNSL, and there's a number of them on the list that have familiarity. So I'm going to go through them one by one, looking at the visual analysis, and I'm looking for a little bit of history. I'm looking for earnings, and I'm looking for up, straight, and parallel. If I can find those things, then they qualify for consideration. We still don't know how they compare. We still don't know if they're a buy at the moment. But the first sift through is just asking for a little bit of consideration with at least 3 or 4 years of history, publicly traded history, some earnings during those 3 or 4 years, and a little bit of up, straight, and parallel. Sometimes I'll take as little as 2 years of up, straight, and parallel, but they should exhibit some of that to make the first cut at least.
And again, for those new to the concept, we are literally looking over the shoulders of somebody who has at least demonstrated that they have been successful in finding these type of companies. And again, as Ken mentioned, GTLS, Massimo, Guidewire, there are just some companies here that have resonated within the community. So we're looking for potential ideas to erupt from something like this. The other thing I would point out, and maybe we'll dig into this a little bit deeper at a future session, is anytime you're looking at a list like this, these are the companies that have actually gone up the most in a portfolio. And there can often be something in the lower tier of the portfolio. You can see this is the top 50% of the companies in. Well, what's in the bottom 50%? Sometimes there could be an interesting entry-level opportunity down there. All right. Here's one of our favorite subjects, how Forbes abandoned us years ago, and they apparently have come back, but they came back in a bad way. Too late to save us for, or to serve us for Halloween, but it's now a Thanksgiving list apparently. But this is the list from back in 2023, but it's a good list. And Ken has already put together a tracking dashboard on this one, so we'll air that out next week and make sure that some interesting targets don't get biased. There's a number of companies there worthy of consideration.
Well, and there's a number of companies on this top 40 here that we've featured at the roundtable, or we've talked about at bull sessions here. I especially want to feature the #1 company. When this list came out, it had just entered the Morningstar database within a month or so of this list coming out, and it had just appeared on the small cap defined screen, and Mark and I added it to the database immediately after looking at its characteristics. At the time we added it, it was not an American company. It was a Colombian company doing 90% plus of its business in the States. Around November, December, January of last year and early this year, Technoglass became an American company, moving its headquarters from Colombia to Miami. And so now we're looking at the #1 company. And folks, if you started investing in Technoglass when we started talking about it, you are a really happy camper right now. There's something to these lists. There's something to paying attention to them. And I think if you look in the top 40 right here, you should recognize a half dozen or more of the names just from things that we've talked about in the last year. There's a lot of really good ideas. There's also a few puppy dogs on this list too, so be very careful.
Yeah, it's a good list. Nice place for discovery of opportunity, and we'll make sure all of those are added and part of the coverage for our small cap and small company safari. Okay, here's a look at the Buttonwood Bulls portfolio. Last week we did add a few shares of Schlumberger Gentex, and we added Raymond James to the portfolio. And we will continue to keep companies that are vetted and on our radar screen on here. Matt would like to add Lamb Weston to some consideration, so we'll stop and take a quick look at that. But that's the total portfolio. Here's an article in Barron's that we just wanted to draw your attention to because, as you know, Ken has been salivating over this company for a month or so. And then I think maybe Andrew Barry broke into his email or his research files and came up with this article for Barron's, but the link is down there at the bottom if you want to take a look at the company. But it's not that same old company, and he's quite high on it. So Ken, as you continue to be salivating here?
I continue to like it. I really like this work that they're doing with lithium. I don't know, is it on this slide
right,
here, Mark,
right
or did
here.
I just read that somewhere else? So you do have it on this slide. Okay. They are doing some, it's not by any means a major part of their business, but lithium production is something that's going to be very important if we're going to succeed in the batteries of the future. Either that or we're going to invent a complete new battery to power some of these automobiles and like kinds of vehicles that we're going to need. But Schlumberger is actually doing some work. They figured out a way to extract the metal 500 times faster than conventional methods and only use 10% of the land in the mining that they normally would use in a lithium mine. So pretty good plus on the company for that one.
Yeah, and it's I mean, the innovative businesses in the new energy environment are, as they say here, a relatively small part, but I can't, overlook the fact that it's a small part of their business, but that's a pretty good sized company in that realm, embedded within Schlumberger. So kind of interesting. And then, of course, this has been a theme of Len Douglas's for a long time. It's just good to see it reinforced. No matter what happens with the powering of vehicles, even if we were to go 100% EV, there would still continue to be a demand for petrochemicals. So good stuff, and we'll continue celebrating.
Mark, there was an article recently in Fortune magazine. I happen to be a dinosaur that gets lots of magazines, and in Fortune, if you go one slide forward, Fortune was designating industries of the future, and they were talking about the 10 biggest industries of the future. And this hydrogen and carbon capture that Schlumberger is doing a little bit of work on right now is one of the biggest ideas for industries of the future right there. That it's going to get it only has bigger to grow as we begin to find ways to capture carbon dioxide and the hydrogen products, the methane gas, the ethane gas, and the things like that, and to take them out of the atmosphere. So Schlumberger's really ticking a lot of boxes besides just making valves for oil companies.
Good point. All right. This one has come up in discussion a few times. It was a potential candidate for Buttonwood. ACMR is the ticker for ACM Research. By the way, I was just noticing, Ken, that this shows up on the list for, where did I see it? I'm pretty sure I saw it.
Number 6.
Number 6. Number 6 on here is this ACM Research, and we were somewhat interested in it. We kind of pulled back to take a closer look at the company. And I guess this is here just for everybody's edification. We weren't able to find any incredibly nasty references out there, and again, the estimates are strong. The revenues are strong. This is in a pretty good field of opportunity. Basically, the laundromat of all semiconductors. Good stuff. But what we did find did revolve around some of this and some of the concern over some of the companies in the Far East and reporting practices, and fur was flying and threats were being made, and they were part of that group back a couple of years ago, but they appear to have ameliorated. That's a big word, huh? The concerns by taking on an accredited domestic accountant and got access to the information they wanted. On the right-hand side, you can see that there isn't a tremendously large short bet against the company. So maybe that issue has subsided a little bit or been addressed. Anything else that any of you guys found on this one?
Well, we were able to track down some negative sounding comments in their annual report. And that's where some of the negativity that was reported at my stock club came from. It turns out that the comments were about things that might happen to the company, not that will happen, but that might happen to the company. And there was some evidence provided by the company that some of these things had begun to cause them a little bit of issue, and that they had solved the issue for the moment. So I think it would be helpful if you're interested in ACMR to go into the annual report and read a little bit about the challenges that the company might be facing. And again, the company is the one providing the information, and they're telling you that these might be problems in the future. And this is something that the SEC requires companies to do, is to lay out challenges that might be there for the business going forward. So ACMR is doing what it's supposed to do and telling you what might happen. But I think that perhaps the person that was doing the research for our stock club read that and thought that they had happened. And that was giving us a very negative read on the company at that point then.
Yeah, and fair enough. Anytime we're dealing with a Chinese company, an extra level of caution is in order, and that's not a reflection on China or the Chinese people. It's just a reality.
Well, and
All right.
especially when it deals with an auditor,
Yeah.
especially when it deals with an auditor that wasn't certified or qualified according to the U.S. and that was doing audit of certain parts of the company's record. They weren't the auditor of record. It's been reported now that ACMR has since replaced their auditor with a completely standard auditor, so that we're going to get numbers that are completely vetted and are meeting American standards. This company is domiciled in Fremont, California. It is not a Chinese company, even though it does a huge part of its business in China and Korea. It's not a Chinese company.
All right. Well, this one is a treat for the audience. This is one that both Matt and Kim independently have told me they find it appetizing. So I'd like to hear more, Matt.
Who
Or
doesn't
Kim.
like French fries? Yeah,
I
so
think
Lamb
it's called a stable in a recession, like
Yeah.
an alcohol stock.
I don't think they found a better mousetrap to bring the French fry to extinction. Not on the horizon. Not even with AI.
Well, this
So Lamb
company,
Weston-
it
Oh,
is
go ahead.
featured in the October issue of Better Investing Magazine, so there's more there to be read. But the situation does seem to be intriguing. Some operational problems. You were saying that they had replaced their ERP system or had some
Yeah. Well,
glitches
yeah,
in it.
that was in the article too. And full disclosure, I won't say I might have gone to work for this company and stuff, come to Texas when I came back from Ireland. But that means I did some research and had some insider views too at the time. So they're a spinoff from ConAgra. They focus on potatoes. I think they're officially based in, I know their headquarters is in Idaho. I don't know where the official plant is, but in Idaho and Eastern Washington. They do have their own brands that they sell into supermarket freezers, but largely sell to commercial customers. Fast food is 80% of the volume in French fries for the industry, not just for them, but of course other restaurants as well. So they do have some cyclicality, as restaurants have cyclicality. There's been a lot of discussion about inflation, particularly at the fast food level, and they've come out with value meals and trying to address that. There's also in the last few years been a lot of innovation here. So it's not just potatoes cut up and then frozen in the bag. There are a lot of coatings. There's a lot of tricks in the packaging. With the rise of delivery services, your French fries need to stay crispy, not just as you walk to the chair in the store or take it away in your car, but for whatever the delivery route is, which significantly extended the time before they got to the customer. And there's been a lot of, believe it or not, research behind that. So I'll say their SSG is quite interesting. That's something that attracts me or piques my curiosity anyway. When they were spun off, they were blessed with negative shareholder equity. So you'll see positive earnings for their whole SSG. It has some cyclicality to it. But in their early years before 2020, you'll see negative return on equity. In fact, negative triple-digit return on equity. You will also see, as the other clue to that, debt to capital of over 100%. And of course, total capital needs to equal 100%. So if debt is more than 100, then equity is negative. And then on the other side of that, since 2019, they have very high return on equity, still with high debt, but it's not that they're paying their debt down, it's that they're building equity. So it's a startup company kind of issue in the data. It is all very strong, and but it may scare away some people who don't really stop to think a couple degrees below that. They have had a difficult year. They've had a couple down quarters in the spring. They had some issues with an ERP migration, which unfortunately, which my friends were involved in because they're in IT. But anyone in IT knows those things happen, particularly with ERP. So that actually impacted some sales. They had a buildup of inventories. They weren't able to keep track of their supply chain or internal inventory so well. They also have invested significantly in their production. They've built brand new, highly automated, highly productive production plants in the US, and they bought out a joint venture partner in Europe. So they've invested a lot in future growth, and those have definitely shown up. Even as revenue has increased this year, their earnings per share has not taken a dive, but has had problems, and will have for at least another couple quarters. Keep that in mind. Their fiscal year is odd. They just finished their fiscal year. Q4 ended in June of 2024, so their fiscal year is weird. Their upcoming fiscal year will still have some issues, but beyond that, it seems to be that a lot of their problems were internal, and not, I mean, the ERP was an internal mess up, but let's say intentional internal steps taken to improve the future. So all that said, to talk about the wiggles in the lines, you can see the analysis here. Sounds good to me. And it's the kind of company, it's great to make sure you do your street research.
Yeah. Well, I will tell, I have an anecdotal moment. I mean, we were going to a family get together a few weeks ago, and we typically take like jumbo shrimp or something like that. And we wanted to do something a little bit different. And my wife actually made up this tray of tater tots, kind of similar to the one on the lower right. And we couldn't keep the pan filled it was a big picnic, basically a big picnic. And that's my little dash of field research. I think that if they are delving into areas like that, and you see the little Domino's logo on there, that could prove to be quite interesting, because I do know that McDonald's is a major customer of theirs.
Well, and another thing I can say is that Oneida frozen potatoes that we all buy at the grocery store,
Mm-hmm.
Lamb Weston is the one who provides them, as well as I've gotten to be a fan of the sweet potato fries.
Ooh,
And they provide those too.
that would go over big here also. Good
And
stuff.
their location in Idaho isn't just tradition. That is the most productive area for, and they go all the way up into Canada actually too, for their feed. They pre-contract a vast majority of their potato production in that area, and that is the most productive area in the world.
Yeah, and my parents lived across from a potato farm in Illinois, so I know. I saw the trucks coming and going. All right.
They
Mark,
also had one other issue last quarter, is when they had, it used to be the Americas, South America, Europe, Asia, and they made it into North America and the rest of the world. So when they report out each of their divisions and what the returns are, I don't know how the analyst just not recognized what was going on.
You know, just more, maybe there are going to be some non-GAAP stuff coming out of that then. Ken, you were going to say.
Yeah, Mark, we have a question from Jim out of the audience, and he wants to know, why is the earnings per share growth forecast so different between regression and calculated? And I'm not quite sure, Jim, what you're getting at there.
Well,
if you'd like, and if you have a mic, we could unmute you. If you want to put your hand in the air, we could unmute you, and maybe you could clarify that question. Go on, Mark.
I think it's on this chart under the EPS calculation.
yeah.
Okay.
In the spreadsheet, you can see it.
Yeah.
Showing.
What you're basically looking at, if we drew a regression line through that data, you'd get something like this, right? Which is going to be, call it 15 to 20% growth. This is something we warn people about on the value line forecast box that's on their page. What they do is they average these three numbers and compare it to this number. And that's why you see one big one and one little one. So the one is just calculated using the standard value line methodology, and the other one is the one that matters more, probably a mid-teens, depending on how many of these lines you put in it or how many of these entries you put in it. But that's the reason for the difference. Keep in mind that the value line just averages these 3 years together, or these 3 years. Anyhow, they pick these 3 years and compare it to that single point. And that's how sometimes you'll get a number that is not incredibly helpful or meaningful in your analysis. Okay? Still got you, Ken? Was that okay?
Yeah, that sounds right to me, Mark. I'm looking at the actual Morningstar data in the SSG as well, and it doesn't match the Y charts forward estimate either. So there's a little bit of dispute about what this company is going to do in 2025 fiscal year 2025, which is, I think, they just begun 25, or they just ended 20. Are they into 24 or 25 now, Matt?
It is
They're
first
starting
quarter
25.
They're in 25 already. Okay, so
Yeah, I think that's one forecasted number, a single.
yeah.
All right, so we will be digging into that one a little bit deeper as a potentially appetizing selection for the Buttonwood portfolio in the future. All right. So with that, here's your reminder that we do archive all of these bull session broadcasts, as well as the roundtables and any other educational sessions that we may do. And they are available on the YouTube page. Just search by Manifest Investing. Let me know if you have trouble finding that. It actually pops up pretty quickly, and there's several years of stuff there. So we'll leave this with one of my I'm really liking the work of this Barry Butler out of Chicago. That's a harvest moon on the left, taken over
That's
Lake
what's
Michigan.
happening today, isn't it?
What? Excuse me?
Today on the horizon, you're supposed to be able to see the sun setting and the moon coming up at the same time, because we're at the closest. I hope everyone can see it, because it won't be here, because all it is rain, clouds.
Yeah, it should be one of the biggest moons of the year. And again, no deference to hot dogs, but just a Clint Eastwood moment. Nobody puts ketchup on a hot dog. I'm told that you can be arrested for that in Chicago. And then one other last moment of remembrance, that is actually from the movie Margin Call, and it actually was based, not very loosely, pretty well based on the Lehman Brothers, Bear Stearns moment from a few years ago. And excellent movie to watch. But it's one of the key moments when they figure out they're really in over their heads and deeply over leveraged. And it was a mess. It was a mess. And then I'm not sure what anniversary it is, but it was September. Back,
Joe is reminding us tonight that there's a partial lunar eclipse tonight also. So if you're part of the country to be able to see that, that might be something to take a look at as well. The moon was just gorgeous last night when Natalie and I were out, so it's just beautiful.
It was. We had a beautiful moon over the tennis court for a while.
Yeah.
All right. Anything else in the hopper?
I think we're all caught up with questions and everything, Mark, and let's wish everybody a good afternoon, and we'll see you again next week.
All right. Thanks, everybody. Go get some French fries and chase it with a Portillo's hot dog.
And some Sam Adams.
And some
Sam Adams beer, yeah.
Man,
good afternoon, everybody.
Keep pouring that Truly down the drain, though. All right. Bye-bye, everybody.